Thank you for joining us on this live webinar. Well, as you know, the markets, they are up one day and then down another. The stock markets are volatile by nature, but for most investors, this volatility can mean uncertainty and unpredictability. So at Geojit, we always tell our clients to make informed investment decisions, to be patient, and then continue with their investments. So to help you make what these informed decisions, you need to understand what is happening in the economy and markets to know what are the challenges and opportunities that it presents. And hence, we have these webinars on a regular basis. Today, we have with us Geojit's Chief Investment Strategist, Dr. V.K Vijayakumar, and Head Investment Strategist, Mr. Gaurang Shah, to talk to us about what is likely to power the equity markets in the coming months, which sectors will benefit and which will be impacted, and what you need to do. Gaurang Shah will also share his stock recommendations, which is something that most of our viewers always look forward to. To get started, let me introduce our first speaker, Dr. Vijayakumar, and he's a retired professor of economics. He's also a keen observer of the economy and the financial markets. Dr. Vijayakumar himself is an avid investor and has been with Geojit since 2010. He has authored many books on economics and presented papers at various international and national seminars. He's a much sought after speaker and writer, and his columns and articles appear in leading financials like the Economic Times, the Business Standard, Outlook Money, Money Control, just to name a few. So let us take this opportunity to listen to Dr. Vijayakumar as he speaks to us about the challenges and opportunities in the equity market. Dr. Vijayakumar.
Thank you, Jyoti. Good afternoon to all the participants. Good afternoon, my dear colleague Gaurang. Welcome to this live webinar. Friends, we are passing through a very difficult time, challenging time for the global economy. The global economy is passing through very tumultuous times. This year, global growth is likely to be only 3.2%. It was 6.1% last year. The three engines of global growth are slowing down. It is important to understand that the global economy has three growth engines. Number one is the US economy, which is a $22 trillion economy. Second is the Eurozone economy, 19 country Eurozone economy. That is a $17.5 trillion economy. And thirdly, we have China, which is a $15.5 to $16 trillion economy. Of the three, the Eurozone is slowing down very sharply, and they are on the verge of a recession. Economists believe that recession in Eurozone is only a question of time. The Eurozone is reeling under an energy crisis because the gas prices have shot through the roof. Gas is not available in plenty, so inflation is very high. So Eurozone is slowing down very sharply, and the slowdown in Eurozone growth will certainly impact global growth this year and next. The other engine of global growth, China, that has been the engine of global growth for more than quarter century now. For more than quarter century, almost 3 decades, China contributed more to global growth than any other economy in the world. But China is now facing major problems. China has a deepening property market crisis. The property market is in deep trouble, and the problems in the property market has spilled over to the financial sector also. To cut a long story short, Chinese GDP growth is likely to be only 3% this year, and it can be only between 3 and 4% next year by some optimistic projections. So when an economy which has been growing by, let us say, 7% a year, 7% was taken for granted in China. When it suddenly slows down to, let us say, 3% or even less, then its impact on global growth will be huge. So China is not expected to recover very quickly. So Chinese slowdown will impact global economic growth this year and next. Coming to US, which is the largest economy in the world and the powerful engine of the global growth, it has been doing well this year. It still is doing well, but then the Fed has been raising rates. The Fed is the American Central Bank. They have been raising rates. They raised the rates by 75 basis points twice, and this coming 21st of September, when the next rate hike is due, another 75 basis point minimum rate hike is expected from the Fed. So when the central bank is raising interest rates like that, the economy has to slow down. So the only way by which inflation can be controlled in the US now is by pushing the economy into a recession. Without a mild recession, inflation will not come under control in the US, and that is what the US monetary authorities are doing. Now, the question is whether it will be a mild recession or a strong recession. We do not know whether it will be a soft landing for the US economy or a hard landing for the economy. There is an important question for which there is no answer right now. Even the Fed does not know. That's why they said our decisions will always be data dependent. So the summary of my initial argument is this: global economy is slowing down. All the three engines of global growth, the US, China, and the Eurozone are slowing down. And when the global growth slows down, naturally, India also will be impacted. Corporate earnings will be impacted everywhere. And interest rates rising by 75 basis points, 100 basis points is not good news for the stock markets. As Warren Buffett famously said, interest rates act like gravity on the markets. Interest rates act like gravity on the market. When interest rates continuously goes up, well, stock prices will have to come down. Of course, there are many other factors also. There have been periods when interest rates rose and the markets also rose. For example, between 2003 and 2007, interest rates have been rising uh, continuously, but the markets also rose because global growth also was very impressive. Higher interest rates, monetary tightening by the central banks did not impact global growth. But now we have a very difficult situation where central banks are tightening into a slowdown. They are tightening monetary policy when the economies are slowing down. That's what makes it a little bit problematic for markets generally. Now, there is a fear, till a month back, market experts and economists were of the view that the terminal rate for the terminal Fed funds rate will be around 3.5, 3.6. But the latest view is that the terminal Fed funds rate can go all the way to 4.25. So if the Fed funds rates go up to 4.25 and remains there for some time, then equity markets can be impacted. So this is the first challenge that the uh, global economy is facing, and and investors also are facing now. Global economy is slowing down, but then this presents an opportunity also. The theme of our seminar is uh, challenges and opportunities in the market. A challenge throws up opportunities also, and there is an opportunity for India because when the global economy is slowing down, the Indian economy is doing well. Recently, the IMF chief said that India is the bright spot among the large economies of the world now because growth is very strong in India. This year, our growth rate is likely to be 7%, slightly south of 7.2% target of the RBI and the government of India. So 7% GDP growth this year will be very good because that will be the fastest growth among the large economies of the world. And next year also, we are likely to grow by 6.4% approximately 6.3 to 6.4. That means India will be the fastest growing large economy in the world this year and next. But that doesn't mean that India will remain as an island of growth when the global economy is slowing down. Global slowdown will impact India also via declining exports or exports stagnating or remaining stagnant. That is very much possible. The pain in the IT market that we are seeing now is a reflection of the uh, co- potential consequences of the global growth slowdown on India's IT exports. So India is doing well, but then even if the global growth slows down and impact India's exports, even then, as I told you, we will have a decent growth because we are witnessing a sort of decoupling as far as growth in India is concerned, a decoupling as far as market performance in India is concerned. I repeat this point, we cannot remain decoupled for long, but the decoupling has a logic. And what is the logic? Let me explain this. India is showing signs of robust recovery in economic growth. The serious investors amongst you might be looking at the macro figures of the Indian economy. There are signs of a clear capex cycle in India, investment in India picking up. Already the macro figures are very clear. Even today, the data regarding tax collections, income tax collections are robust, corporate tax collections are robust, GST collections have been consistently above 1.4 crores for six months or 7 months already this year. So these are all signs of an economy uh, showing robust economic recovery. Our credit growth, this is hugely important from the market perspective also, because there is a very good message from this for financial stocks, particularly banking stocks. Our bank credit growth now is at around 16 percentage. Latest data from the RBI tells us that credit growth is at 16 percentage. So 16 percentage credit growth is a 9 year to 10-year high as far as credit growth is concerned. And non-performing loans are at a 15-year low. Our corporate leverage, that is the corporate debt to GDP ratio, is at a 15-year low. These are all very, very important. Bank credit growth, asset quality of banks improving, uh, corporate sector getting deleveraged. All these are signs of the economy showing a sharp rebound. And that's why we are very optimistic about the growth rebound in India and Indian markets throwing up opportunities when you have challenges in the global economy. Challenges in the global economy means there will be volatility, like we saw today with the Sensex having a cut of more than 1,000 points, and many blue chips cutting by or declining by 4%. A stock like Infosys going down by 4% within a few hours. It does not happen all the time. So this kind of volatility in the market will throw up opportunities also. So these opportunities will throw out great chances for stock investors. And my colleague Gaurang will share with you the uh, stock specific information which always he shares with investors, and it has always stood in good stead for investors as well as for the company. So he will give you more details regarding that. But let me make a couple of points before I hand over the mic to Jyoti and to Gaurang. So I made 2 points now. Global economy is slowing down, but Indian economy is robust, and India will be the fastest growing large economy in the world this year and next. So that presents investment opportunities. So the question is, where do we invest now? Where do we invest in this highly volatile market? Well, broadly, I'm not going to sectors. I'm not going to stocks. That is Gaurang's domain. I'll just share with you one theme. since the global economy is slowing down, we have a challenge there. But India is rebounding, we have an opportunity there. So it will be always better to focus on uh, India economy facing sectors. Economy facing sectors, India domestic economy facing sectors and stocks at this juncture in this market at this time in the market, because the domestic economy is doing well. So if the domestic economy does well, if credit growth is at 16 percentage, if asset quality of banks are improving, this double whammy, the positive double whammy of 16 percentage credit growth and improving asset quality of bank schemes, banks will continue to do well. In the two webinars we had a few months ago, we were very strongly recommending, even when we were a little bit skeptical about global markets, the markets in general, but we were very, very optimistic about financials, and financials were specifically mentioned for strongly recommended for investment. Banking stocks like ICICI Bank, Kotak Bank, State Bank of India, IndusInd Bank, all these banks were specifically mentioned for investment, and look at the performance of these stocks. They have done exceedingly well. So when you focus on domestic facing stocks, domestic economy facing stocks, number one priority will continue to be financials, particularly leading banks, leading private sector banks, with a couple of PSU banks, and then fintech companies like, for instance, Bajaj Finance. Gaurang will explain more about that. Secondly, our capex is doing well. I told you capital goods is one segment which has not been doing well for many years. When you have capex, capital goods segment will do well. Our RBI RBI governor Shaktikanta Das, in his last monetary policy announcement, made this point specifically. He said, capacity utilization in manufacturing in India is now uh, about 75%. Capacity utilization in manufacturing at 75% is a very important threshold, because when capacity utilization in manufacturing goes above 75%, then that is when capex begins, right? And if you had observed the performance of capital goods companies like Larsen and Toubro, Thermax, Asia Brown Boveri, Siemens, well, these have been doing exceedingly well even when the markets were weak. So that is a market's message that capital goods is one segment which has got strong potential. Then consumption, automobiles, discretionary consumption, automobiles are doing well, commercial vehicles, passenger vehicles, two-wheelers specifically in certain segments, they are doing well. FMCG is doing well. These are the sectors where we have to focus in the coming months, when the Indian economy will be doing well, even when the global economy is getting challenged. And the two sectors which are a little bit weak now, as I told you, are IT, and the other is global commodities, particularly metals, because particularly when China goes into a deep slowdown, global prices will be impacted. IT also will be impacted. IT has already been impacted by concerns of a probable US recession, and also the high level of attrition in the industry. High level of attrition, and attrition means new recruits will have to be paid high salary. So there is a margin pressure in the Indian IT industry. But then, having said that, let me also say the stock prices have corrected substantially. I think IT index year till date is down more than 31%. Right, so there has been substantial correction, and this kind of correction will throw up opportunities for investment in the IT segment, even though when there is global slowdown, many institutional investors may be avoiding that sector. But then it will throw up opportunities. I will look forward to Gaurang's views also on this specific thing. Let me conclude by making one final remark. All the investors would have heard about India becoming the fifth largest economy in the world now, with a 3.2 trillion GDP. Uh, Even though the GDP size is very big, we have a long way to go as far as the per capita GDP is concerned. We are even now only $2,000 as far as per capita income is concerned. But at $2,000, when we move from 2,000 to 3,000, 4,000, and 5,000, and when Indian GDP becomes, let us say, $5 trillion, and then some, let us say, $8 trillion, $10 trillion uh, by 2032, 33. That means the Indian GDP is going to get tripled in the next 10 years or so. Market capitalization also will get tripled. So there are great opportunities there. So don't look at what the Sensex and Nifty will do next Monday or next Tuesday or in October or November or March 2023. Nobody can say that. Let us not bother about that. Let us focus on India becoming a 5 trillion economy, a 7 trillion economy, and a 10 trillion economy by, let us say, 2032. And if you look at that, there is going to be phenomenal wealth creation in the next 4 years, 6 years, 8 years, and 10 years. And the best way to profit from this wealth creation is to invest in high quality stocks with the potential to create wealth and stay invested patiently. And those investors who do not have the expertise to invest in the market directly, they can invest through systematic investment plans in mutual funds. Thank you. Over to you, Jyoti.
Thank you, Dr. Vijayakumar. And as Dr. Vijayakumar said, the markets may be unpredictable in the short term, but over the long term, they're definitely going to give you good returns. So stay invested. Uh, our next speaker for the day will be familiar is a familiar face for most of you who watch leading news channels like ET Now, CNBC, TV18, CNBC Hours, etc., to name a few. Mr. Gaurang Shah has over 20 years of experience in the capital markets. He is an expert in the global markets and its impact on Indian markets. He regularly offers advice on investment opportunities across stocks and sectors. And uh, as discussed a little earlier, he's currently in Baroda for an IAP. That's something that he always does, interacts with all our clients, and he's more than willing to share his views on the stocks and sectors that are worth investing. So over to over to Mr. Gaurang Shah.
Thank you very much, Jyoti. First of all, let's just check. Is my audio video loud and clear? Everybody can hear me?
Perfect.
Yes, loud and clear.
Okay, great. Thanks. Thank you, everyone. Good evening to all of you all, and thanks for being a part of this webinar. And thank you very much for signing in. Good evening to you as well, Dr. VK. And thank you to the entire team, along with Jyoti, Elizabeth, Arya, and all those who are involved in putting this webinar together. Thank you very much for giving us this opportunity. And to our clients to log in and listen to Dr. VK's view and my outlook on the market as well. So, friends, as my good friend Dr. VK was mentioning, markets will do what they have to do. And I think investors like you and me have to do what we have to do in a disciplined manner. Markets can possibly correct going forward from here on. And as the topic says, challenges and opportunities. So first, let me speak about some of the challenges that I feel. Of course, Dr. VK has highlighted a couple of them. Uh, I would also like to highlight a couple of few more. So you have, first of all, geopolitical situation, one existing in form of Russia, Ukraine, another one coming to life in form of China, Taiwan, and an everlasting fear or a threat, not a fear, an everlasting threat as far as India is concerned, because on its shoulder lies Pakistan and China. And there has been multi-decade issues with respect to border and terrorism with both these countries, especially with Pakistan. So there were a lot of questions also asked to me during this course of time in the last couple of weeks. What if there is another unpleasant situation that arises because of geopolitical situation with respect to China and Taiwan, or with respect to India on one side and Pakistan and China on the other side. So I think these kind of geopolitical situation can lead to a lot of challenges. We have already seen one happening. A couple of more in the past we've seen. The uncertain times in the Middle East and how that had its effect on the crude oil prices, etc., etc. So geopolitical, it's a clear and present danger. To predict how this clear and present danger will evolve, I think it's extremely difficult. One will have to possibly take a calculative move or a decision as and when these kind of situation arises. First of all, let's pray to Lord Almighty that we don't have to see another conflict like this or a new uncertain geopolitical situation, because that may lead to multiple domino effect. So that's one. The second is inflationary pressures. 4 decade high as far as US is concerned, UK at 41-year high, interest rates at multi-year high, government spending slowing down in the developed markets, US, Europe. Energy prices, as Dr. VK was mentioning, is sky high, and gas has become a scare commodity, which leads to economic slowdown. Uh, Interest rates revision also has its impact on the GDP front. Uh, Absence of FIs may also lead to a lot of vacuum. Along with that, I think capex spending from the government or private will also result into unemployment rates going up. So there are one too many problems. I can go on and on and on. But I think we all are a little bit more familiar with what are the challenges that lies ahead as far as our markets are concerned, India is concerned, Indian equity markets are concerned. But in the same breath, I would also like to highlight the outperformance that India has shown in terms of not only the equity market performance, but also in terms of GDP. 7%, no one close to even 6% mark, and we are at possibly we will be growing at 7%. That's what the very learned brains have estimated, and very credible institutions have put forward that kind of number. So I think if I have to summarize all these challenges, and if I have to zero it down in terms of opportunity, then I will just say one simple line. And that is, we are in a much better place. We are in a much better shape. We have got a very clear growth path in front of us. And we will be the first ones to turn around as and when the world turns around. We will possibly take the lead. So this is a summation of what the challenges are. In terms of opportunities, I can identify again one too many, but let me just stick to some of the basics. As Dr. VK was mentioning, second quarter numbers in terms of tax collection were out. We were anywhere higher compared to year on year by a margin of 20 to 25%. In some cases, it was in excess of 30% as well. In terms of corporate growth, Q1 numbers, we delivered largely in line. Second quarter, maybe will do a little bit better. Third and fourth quarter could be challenging depending upon what happens to the rest of the world. In terms of China, China plus one policy has got its tremendous positive impact for the rest of the world. That is in the Southeast Asia Pacific region. India being one of the largest beneficiaries because of the government policies that have been put in place in terms of production link incentives. In terms of GST collection, my friend Dr. VK was right. We are clocking in excess of 1,40,000 crore for the last 2 to 3 months. In terms of inflation numbers, well, the last number was a little bit high, but if you go to see minus the last number, the earlier numbers, three numbers, were continuously coming lower. So possibly we are seeing a little bit of stabilization as far as inflation is concerned, and possibly if things act in our favor, then we'll see a trajectory lower rather than seeing a trajectory higher, which is the case in other countries and other developed and emerging markets. A rupee dollar equation also will play a very crucial role. But it's not that in the Indian rupee is only corrected against the or depreciated against the dollar. Other Asian market currencies, emerging market currencies, including the euro, has weakened against the dollar. In effect, dollars has strengthened against all the major currencies in the world. Crude oil prices, this is very significant to us because we largely depend upon imports of crude oil, and higher the prices, weaker the rupee, we have to pay, we have to face the double-edged sword, because that cuts deep into our government, treasuries, in form of the rupee depreciation and in form of oil pull account deficit. So that's a pain over here. But again, since this Ukraine and Russia situation has arisen, we've been able to garner or take care of our energy requirement in form of crude oil to a great extent via imports from Russia in form of crude oil and natural gas. Remains to be seen how much we can better over there. So we are relatively better off now as far as that situation is concerned. In terms of government spending and private sector spending, I think that should pick up speed, and that could possibly take care of unemployment to a great extent, because large scale employment happens when government starts spending, when corporate houses go into capex overdrive mode, etc., etc. So there are problems in the very near term. Yes, I agree with Dr. VK. 0.75 basis point hike by the US Fed and the comments made by the Fed chief, Mr. Jerome Powell, I think this is a reality. And the more we accept the reality, the better it is, because we will possibly reach a stabilizing level sooner if we start accepting this, new normal, as we call it. So, what happens to us in this kind of a scenario? Being a part of an emerging market, one of the fastest growing emerging market, we will also react to what happens in the rest of the world. But the good part is that we don't overreact. And whenever there is a reaction, there is a counter action that comes in form of smart and informed investors looking at all opportunities of correction to get into the stock market and buy some quality, strong names with credible management, with uh, clear growth in terms of business strategy, etc., etc. And if I have to look at the population of India, a large part of the consumption comes in from semi-urban and rural India. Because of the rain gods being favorable to us for the fourth consecutive year or the fifth consecutive year, I think the spending capability and capacity from semi-urban and rural India is going to propel the consumption theme going forward from here on. Along with that, you have back to normal in terms of metros and tier 2, tier 3 cities. So consumption will come in thick and thin from there as well. And let's remember one thing, India is a consumption driven economy. And that is one of the reasons why the best of the best in the world want to come and set up their shop in India, because India is a market wherein consumption can slow down, but it will never stop. So, and I think the bad times are already behind us. We are slowly coming back to the new normal, pre-COVID levels. There are certain numbers that tell us that we are coming back to the pre-COVID levels. I'll just give you one or two simple examples. The occupancy run rate in terms of room occupancy for hospitality industry is one indicator. In fact, to that extent, I've heard some of the top management of some of the hotel industry speak that they are expecting an upward revision in room tariffs by about 25 to 30%. Equally better is the run rate in terms of airlines, flight occupancy, realization per seat, etc., etc. So if all these things are and these, mind you, are not common man's travel mode or destinations to stay. These are very high and a premium segment kind of categories that I'm speaking about. So if these can command a high premium in terms of new normal, I think down the line we'll definitely have a better story to tell us in terms of where we are. So in and all, I think markets have to correct, markets will correct, markets will do what markets feel in its wisdom is right to do. And in my sense, if I have to identify opportunities, and of course, I have shared some five, six sectors with our team. I hope Jyoti would have possibly made a slide of that. If not, I would request Jyoti and team to possibly make a slide of that stock ideas or recommendations that I'm going to speak in a while, so that it will be easy for you all to take it down as and when that display happens on the screen. I think that will help you to note down the names. Anyways, if not, then I'll also give in some names in terms of verbatim and inputs. So, friends, I always say this, and I will keep on saying this. And the statement is that you can hate India, but you cannot ignore India. Hate India in the sense, you want to stay away. Ignore India in terms of opportunities. You cannot let go of those opportunities. And whatever amount of FI selling has happened in the last maybe about 11 months or so, slowly, steadily, all these FIs are going to come back because there is no better place to hide other than India, at least in the given situation and circumstances. But there is another problem. If there is too much of liquidity coming into the market, is also a problem of plenty. So I think in a staggered and a steady way, if you are going to see that improvement, then definitely it is a positive sign. Along with that, I think the retail investors' participation has increased. Only the recent data that has come in from uh, AMFI in form of SIP inflows, then that is again come at a very elevated level. Though there was redemption in some of the funds, but the overall SIP flow was one of the highest for the month of August that went by. And my sense is that as more and more investors start associating and becoming an active investor via equity market platform or via mutual fund SIP platform, I think that's going to be an inherent strength which nobody can take it away from us. So my sense is that slowly, steadily, a lot of people are coming back. There are challenges. We will overcome this. And let me tell you, despite of being a country with a population of 140 crores, I think India was one of the first ones to come back to new normal. Despite the fact that you had so much of diversity, you had so much of resistance in form of vaccines, etc. You had so much of resistance in terms of following the protocol of COVID appropriate behavior, if you call it. Despite of all these challenges, some countries are still struggling. China itself, as my good friend Dr. VK was mentioning, and I'll tell you one thing: China, anything bad for China, according to me, and I stand to be corrected if I'm wrong, anything bad for China is good for the rest of the world, especially India. This is what my philosophy is, and I always follow that. And let me tell you, the reference made by my good friend Dr. VK with respect to the real estate sector situation in China, that has actually led to a domino effect in the sense default of real estate sector has led to default in metal sector, cement sector, and other related sectors because they went on full steam ahead in making huge ghost towns with 30, 40, 50 floor towers with not even a single soul to live in. And now the situation is all those real estate companies are finding it difficult to survive. And their survival becoming difficult translates into difficult time for metals, cement, ancillary companies, electrical companies, etc., etc. So my sense, friends, is that yes, there are difficult times, but I think we will sail through this also. We have been managed to come through much difficult times, and I'm quite sure these times are not going to last for more. And if you are thinking for long term, as always, we at Geojit have been recommending to use that opportunities on dips to buy into get invested into strong fundamentally sound names, because when you buy in a falling market, you automatically increase your profit margin. You buy in a rising market, you automatically sacrifice the profit margins that you have thought of. So this is one simple calculation that at least I have learned without any new rocket science involving in this. Buy at a discounted price, you increase your level of profits. You buy in a rising market, you sacrifice the profit margins that you are supposed to make or likely to make. So I think all these difficult times will also see the end of problems. And as and when we come out of those dark clouds and look at that silver lining, I think we will be the first ones to look at that. So from that perspective, I will possibly look at certain sectors which we feel are great opportunities to look at in terms of investment idea. I would request our team, Jyoti and rest, if they would have possibly, yeah, if they're able to get a hang on the stock list and the recommendation, then they can possibly display it now because that will benefit yeah, there it is. Thank you very much, team, for putting in this slide in such a short notice. So, friends, what we have been doing is we've been periodically having this webinars, and we've been getting in touch with our clients at their home place of comfort and have this interaction. We answer certain questions also, both Dr. VK and myself. And I have been entrusted with this great responsibility of identifying investment ideas sectorially. And every time I try to come out with some new ideas, the sector may be the same, but there'll be new names added to it. Maybe some of them would be repetition. For example, IT, because IT is down and out, like 30% downward correction. But I believe it's a great opportunity. So I'll start with IT first. So you have names like Tech Mahindra, HCL Tech, and TCS. Last time also we recommended some other names way back in June when we had one of the webinars. We had covered other sectors also. So I'll give you one simple example, friends. If in our day-to-day life as an individual, if IT plays a crucial role, then for corporate India or for a small scale, medium scale, or large scale enterprise or a corporate, it is equally important. You cannot stay away from IT environment and make yourself vulnerable. Yourself means your company's IT platform and environment vulnerable to any kind of external attacks. So companies will keep on spending. It may differ in terms of how much they spend, but it's not like they're not going to spend. You and IT, you need to keep yourself updated. So we believe that there could be pain for the next 1 or 2 quarters as far as IT earnings are concerned. But post that, that is, I'm talking about next financial year, I think IT will come out equally strong. And these are the opportunities to nibble into some strong names. Three of them are in front of you. Tech Mahindra, HCL Tech, TCS. Other than this, we are positive on Infosys, KPIT Tech, Tata Alexi, Mindtree Persistent Systems, and L&T Technologies, just to name a few more for your benefit. Specialty chemicals. Now I'll come to the first one. This is one sector, friends, which will be one of the greatest beneficiary of China plus one policy. And this PLI scheme has also been helpful for the specialty and agrochemicals. More so agrochemicals. Why? Because India is, historically a country which produce a lot of agri produce. And like I mentioned, fourth, fifth consecutive year of a very decent or above normal rainfall. I think our agri output is also going to multiply to a great extent. So you have names like Viniti Organics, UPL, Tata Chemicals, PI Industries. Uh, uh, Possibly you can look at Pidilite also. So these are some of the names in the specialty agrochemicals universe, which we believe will be one of the beneficiaries of China plus one policy. One of the most important sectors that we always speak about, as my good friend Dr. Vico was mentioning in his earlier part, banking and finance. Now, if India has to become a 4 trillion, 5 trillion, or a 6 trillion economy, how are we going to achieve that if we do not have a robust and a strong banking and finance sector? Because everything that needs to grow needs some amount of fertilizer in form of cash, liquidity, credit demand. Where does it come from? It comes from banks and NBFCs. And if banks and NBFCs are not able to provide you that, then how are we going to become a 4, 5, 6, 7 trillion economy? So anything that any country, in fact, not only India, let me tell you, friends, any country in the world would also want an equally robust banking and finance sector. And with the kind of tremendous turnaround that we've seen in the earning visibility, my sense is that demand growth is not only going to come, it's going to come in very, very thick. And the repayment capability and capacity of principal and interest is equally going to be much, much stronger, which translates into lower gross and net NPA, lower provisioning, interest rates revisioning on the upside, gives a better scope of margins as well. So you have names like Kotak Mahindra Bank, IndusInd Bank, Federal Bank. In NBFCs, you have names like Mahindra and Mahindra Finance, Bajaj Finance, Cholamandalam Investments, Shriram Transport Finance. These are some names. Of course, along with that, you have Axis, ICICI, HDFC Bank. The reason why I have not mentioned this name, friends, is because we've already spoken about these names in the earlier webinar that we've had. So these are additional names other than those names that we are positive on. In the public sector banks, because over there also we have seen some meaningful uh, improvement in terms of earnings. So you have names like State Bank of India, you have names like Bank of Baroda, you have names like Bank of India, Indian Bank, just to name a few. I think banking should be one of the top priorities. and a sizable amount of your portfolio should be allocated to banking and finance. And then you have metals. Uh, I am totally of an opinion that the demand and consumption, government spending, private sector capex spending, uh, a more than better turnaround in the real estate sector will have benefits translating onto metals and cement. So you have names like Tata Steel, Vedanta, GSW Steel, Hindalco. These are the names in the metal universe. We have cement names also. We have names like Dalmia Bharat Cement. I don't know whether my colleagues have also if they can go on to the next slide, Jyoti or anybody who's here to, yeah, there it is. So in cement, you have Ramco Cement, JK Lakshmi Cement, and Dalmi Bharat Cement. These are more of the mid-cap universe in the cement that we are extremely positive. Again, large cap names not being repeated because they were mentioned earlier: ACC, Ultratech, Ambuja, Grasim, etc., etc. Auto ancillary. I'll just give you one report that I read about 2 days back, and that report tells that in the next 4 to 5 months, there are going to be different categories of passenger vehicles from different companies getting launched, and the number is anywhere between 16 to 17, 16 to 17 new launches in the next 4 to 5 months. Long waiting period, better situation in terms of chip semiconductor, logistic side issues getting better, month-on-month sales number coming in at a much better level and expected it to be better. I think you should definitely keep your eyes on Tata Motors, M&M, Bajaj Auto, Eicher Motors, Ashok Leyland. These are some of the core automobile plays. And in terms of auto ancillary, you have names like Mahindra CI Automotive and Bharat Forge. Because anything good happening to auto translate into better times for auto ancillary, OEM, battery, tire manufacturing companies, etc., etc. Last but not the least, as I mentioned in my earlier, statements, uh, uh, the India is a consumption-driven economy. Imami, Dabur, Tata Consumer Products Limited, Godrej Consumer Products Limited, HUL, ITC. I think these are the names that we associate every day in our consumption day to day. So my sense is that these are some of the names in the sectorial universe, 7 sectors. I think you must have at least read about 35, 40 odd names. My humble request is that you don't need to buy all of them. Try to look at what you have understood better, what you feel is much better, rational it out, reason it out. We have research reports on all these companies. Get in touch with our branches, our team in your respective city. They will help you with the research report. Before investing, just go through the report so it's better understanding for you as well. But friends, my overall conclusion is that uh, you know when the going gets tough, the tough gets going. And when you've seen the worst, then the best is yet to come. And I think we are going through some difficult and challenging times. But I'm quite sure, like earlier times, we will overcome this as well. And our back of the envelope calculation, if you will, friends, I think we should possibly heading towards new high by Diwali or December 2022. And if all goes well, and if macros and indicators and data points are supportive, then I think by next year, 2023, we should be, you know, staying well above the all-time highs that we have made. I hope I'm right on this. This is subject to a lot of, disclosures because things are evolving every day. But just looking at the recent past history and a distant past history, my understanding tells me that we should be much better rather than being worse off, given the kind of opportunity that lies ahead of us. So try to look at markets correcting as an opportunity to buy, create a very strong portfolio, and I think you will be having a very smooth landing for your future goals as well. Thank you very much for listening to me so patiently. I'll hand over to my friend and colleague Jyoti in case if there is something more. Otherwise, I don't know if we have enough time to throw the floor open for the Q&A session. Jyoti, are you there with me?
Yes, very much, Mr. Shah.
Great.
So
Thank you so much.
quickly,
Take it
we'll
over.
move on. Quickly, we'll move on to the Q&A session. The first set of questions are for Dr. Vijayakumar. We received a lot of questions from uh, um, all our clients, and I'm sure that most of your questions have been answered through the presentation that were made by Dr. Vijayakumar and Mr. Shah. So the first set of questions for Dr. Vijay Kumar. The first one, is it time now, is the time now ripe for picking small and mid caps?
Well, small and mid caps is it's a very tough area. The ideal way to invest in mid and small caps would be to invest through the mutual fund route, because that's a landmine. It's a minefield actually. That's a minefield, because I know of large number of retail investors picking up small caps losing big. Therefore, ideal way to pick up make investments in small and mid caps is to invest through the mutual fund route. But if you are very confident about a particular small cap or a mid cap, please go ahead. No problem.
The next one is central bank is increasing the interest rate. What do you think the maximum interest rate in 2022-23, and how it will affect the equity market? Will there be a shift of fund from equity to bank deposits, debt funds?
That's a tough call. Globally, interest rates are going up. The Fed is tightening interest rates. ECB is tightening interest rates. But then in India, inflation is relatively lower compared to the inflation in the developed world. But then the RBI has been raising interest rates, and not, I think the repo rate is 5.4%. It was only 4% during the COVID cutting phase. So even if inflation remains low in India, goes below 7%, if interest rates in the US is steadily rising, RBI too will be forced to raise rates so that a capital flight from India is prevented. It is quite possible that the terminal during this tightening phase, the terminal interest rates in India, the repo rate can go up to 6%. That is possible. Can go up to 6% if interest rates in the eurozone and the US continue to rise. But then it is not going to impact the market in any big way, because we know the returns from the stock markets, the equity markets are much higher compared to the returns from fixed income. So it will only have a very marginal, negligible impact.
Well, Dr. VK, the next question is something that we get asked every single time, but I'm still asking you, will the market remain stable or will it go up and down, and whether to invest now or wait for some time?
When Peter Lynch was asked this question, will the market go up or go down? Can you predict the market tomorrow? He said the market will fluctuate. That's all that an investor can, I mean, even an expert can say. Well, as my friend Gaurang told you, leave the market to the market. Let the market do whatever it wants to do and can often surprise. Let us not bother about what Putin will do in Ukraine, what Jerome Powell will do regarding interest rates in the US, what Shaktikanta Das and the Monetary Policy Committee will do as far as interest rates are concerned. Let us look at what the Indian economy will be doing in the next couple of years, 3 years, 5 years, when we move from a $3 trillion economy to a 5 trillion economy, 7 trillion, and ultimately a $10 trillion economy. Let's not bother about the day-to-day dynamics in the market. Let us focus on the long-term story. And from my experience in the market, I've been an investor since 1984. And from my experience, I can tell you that it is easy to make money through investment. It is easy. But vast majority of retail investors are not doing that, because instead of investing systematically in stocks, they dabble in the market, buy today, buy in the morning, try to sell at a profit in the evening, but they actually incur a loss by evening, things like that. So focus on high quality stocks. My friend Gaurang gave you a list of good sectors and stocks where you can invest. These are stocks that has got the potential to create phenomenal wealth, not just in 1 month or 3 months or 6 months, but in the years ahead. and invest through mutual funds or the systematic investment plan. Don't bother about what the market will do next week or next month.
One last question before I let you go, Dr. Vijay Kumar. My son wants to invest for the next 10 years. He thinks for 18 to 20% returns. Is it uh, possible in the equity market?
Anything is possible in the equity market, but 20% a year would be a very tall order. Only Warren Buffett, I believe, got 20%. So if he gets 20% for the next 20, 25 years, he might become another Warren Buffett. I think it would be realistic to expect 14%. 14% is what the Indian markets normally deliver. Because when you have a 7% GDP growth and 6% inflation, that will be 13% plus 1 is the premium that the market will give you. So 14% compound annual growth rate for 10 years, 15 years is good enough, because through the power of compounding, it can create phenomenal wealth. 20% is something that you can aim for, but I would be very happy with 12 to 14%, because that itself, when you are getting only, let us say, 5% from fixed income, if you're getting 14% from equity, then that means equity is far outperforming fixed income.
Thank you, Dr. Vijay Kumar. Now I'll move on to Mr. Gaurang Shah. Uh, the first question for you is from one of our listeners today. He wants to know Mr. Prasad wants to know what is the rationale for Tata Motors in the list. It earns significant revenue from abroad, China, and others. This contradicts your story of India facing companies.
So, Mr. Prasad, markets are all about contradiction. And it's better to contradict rather than to agree, because to not agree also makes a very healthy discussion. So I come from a camp where uh, I believe that Jaguar Land Rover are not only country specific passenger vehicles for China or UK. Jaguar Land Rover are equally seen on Indian roads, in Middle East and elsewhere in the world. Yes, a sizable amount of revenue does come from China and UK, but my sense is that slowly, steadily, Tata Motors have tried as a business strategy to shift that focus, and somewhere they have been successful. Along with that, if I have to bundle up the domestic business, that is in form of Tata Motors commercial vehicle, light commercial vehicle, medium commercial vehicle. 2 days back, they launched a new series of commercial vehicle with ADAC facilities, which are normally available in passenger vehicles. 80% market share in electric vehicles belong to Tata Motors. At least 6 new launches lined up over the next couple of months. Along with that, today report I was reading, Tata Motors is working on a 2 liter plus diesel engine. They are also working in certain capabilities and capacities wherein they would focus critically on clean and green platforms as far as passenger vehicles are concerned. So if I had to sum up all these things, and if I have to look at the share price of Tata Motors, then I see opportunity. I'm not saying that you will see levels of 550, 600 in the next 2, 3 months, but you will definitely see these levels over the next year, year and a half. So my counter argument is, and along with that, I think if you want to go and buy, whether you buy a Tata Nexon or you buy a Tata Safari or you buy a Tata Harrier, all of them have a waiting period, even in whatever segment and whatever form you want to buy. Along with that, you have very healthy, robust commercial vehicle making comeback. Scrappage policies to help commercial vehicle manufacturing companies to better the numbers. And if you have to focus on the logistics sector as well, wherein the government is working on a new policy, I believe maybe sooner or later you will have that policy coming out. Tomorrow, I believe you will have that policy coming out from the government in terms of logistics sector. Then the demand from fleet owners and logistic companies will only increase going forward from here on. Scrappage policy will also help in terms of replacement of old and polluting commercial vehicle. So to to sum it up, and of course, this chip semiconductor issue now slowly resolving will also improve the health of JLR. So I think it is an opportunity. If you are convinced, then you can definitely go and make an investment. But on the fundamental side, we at Geojit are positive on Tata Motors from a long-term point of view. I hope I would have answered your question.
The next question, Mr. Shah. In the present scenario, is it worth buying defense related stocks?
So defense was something that we were positive, I think, last June in the webinar. I remember, I hope Dr. VK would also remember, defense
Yes.
related sector was put out wherein we had mentioned stocks like Hindustan Aeronautics Limited, Bharat Dynamics Limited, BEL, to add a few more, Cochin Shipyard, Musgao Docks. These are also actively involved at the defense. The problem is Hindustan Aeronautics Limited and Bharat Dynamics Limited and BEL. In the last 3 odd months, they have rallied to a great extent. But whether they are still candidates for investment with a 2 year, 3 year time horizon, I definitely think they are. Only thing is, don't put all your money at one time. Stagger your investment. In effect, start at current levels, maybe 25-30%. And when you get corrections, go on adding to that stock.
The next question is Idea Vodafone recommended for subscription considering the government's stake?
Well, the government stake is in plenty of PSU companies, and we all know what is the situation over there. And now government is thinking of coming out from them. And these two companies, if I'm not mistaken, and again I stand to be corrected, we used to cover Yes Bank and Vodafone Idea kind of stocks long time back. But then because of the multiple headwinds and the issues and the financial stress that is there on the balance sheet, and I was just reading today also, Vodafone is one of the largest loser of subscriber base to Bharti Airtel and Jio, that is Reliance Industries. And if you go on losing 10 lakh, 15 lakh subscribers every month, at the end of the year, what will you be left with? Whom will you cater to? That's the big question mark. And from where you will get the revenue. So it is better not to look at what government does. It is better not to look at these kind of companies. If you want to look at telecom, Bharti Airtel and Reliance Industries, because of Geo business, we are extremely positive on these two names. Jyoti?
The next question is, can LIC ever reach its IPO price in the near future? It was such a disappointment to invest in LIC.
First, let me have a sip of water before I answer that. So we had a subscribe note on LIC IPO from a long-term point of view. And will it ever reach the IPO price and beyond? I strongly believe so. And why do I believe so? I'll just give you a rationale because we are running short of time. I'll just try to sum it up in few words. Post pandemic, the entire dynamic of people looking at insurance as a policy, insurance policy has changed. Earlier, people used to look at this in a tax saving point of view. Now they look at it as an instrument to safeguard their dependents and family members' future if something has to happen to them. Not only are they buying large sums, but they are paying larger premium as well. And this will improve as we go forward from here on because India is a huge population and the percentage of people taking insurance, again, if I'm not wrong and I stand to be corrected, is at a lower single digit. So you have a huge market in terms of insuring the uninsured. So my friend, have patience. I'm quite sure not only LIC, ICICI Prudential Life, SBI Life Insurance and HDFC Life. All these four companies will see light of the day. You need to have patience. Jyoti?
The next question is, if I am having a corpus of rupees 1 crore, how much money can be invested in equity to be on a safer side? I am a 70-year-old retired person.
So, with you, with all due respect, sir, ma'am, uh, if you are 70-year-old, first of all, let me say this to everyone who is being a part of this webinar. Investment into equity market is all about high risk, high return. Equity markets are exposed to all kinds of internal and external risk. If you are prepared to digest the volatility and take risk, only then come to the equity market. There is nothing like safe, secured, or guaranteed. These are alien words for me as far as I am concerned, and I'm sure for Dr. VK as well, because in equity market there is no guarantee, there is no surety. Everything is absolutely insecure and everything is high risk. So be prepared for it. If you are 70, I would request you to take a professional advice from a financial advisor who's qualified. Given that you are 70 plus 70, I think you will definitely have a relatively low risk appetite. But to answer your question, I think put 25-30% into equity and the balance in some kind of investment asset classes wherein you get a reasonable return every month. I don't know if Dr. VK can help. Dr. VK, can you help in this?
Well, a person's risk appetite to a large extent depends on age. And if he's an investor who has been investing for the past many years, of course, he can go ahead and do that. But from the question, it appears that he's thinking of investing in the market afresh with a corpus of 1 crore. Therefore, I completely agree with Gaurang's views on that. His risk appetite is low, and he should be putting maximum 30% in equity, and that too only after getting professional advice from qualified people.
Thank you, sir. The next question is which are the main factors to be considered while selecting stocks for investment? Please give examples weighing these factors.
Well, so there are not one, two, three, there are one too many. And we look at a 5 year balance sheet, we go and meet the management, we take into consideration more than one and a half dozen ratios. So my request to you, sir, ma'am, would be that get in touch with our branch. We regularly come with fundamental recommendation. We do all the work for you and we come out with a small presentation in an A4 size paper giving rationale as to why we like that particular company and why you should invest in that company and what are the growth prospects and what are the targets. So if you want to do this, you have to look at 5 year balance sheet, break and crunch the numbers uh, with almost about one and a half dozen ratios, meeting with the management. If possible, we also do site visits, factory visits, etc. to understand it better. So it's not just one, two, three, it is one too many. And the better thing for you would be to get in touch with our branch and ask them to give you the latest research report over the last 3 to 6 months. That will make the things very easy for you. Jyoti?
Well, I'd like to wind up with this one question. Which stock market is the best in the world?
By default, India. And I don't think anybody comes closer to us. So I'm quite uh, optimistic. I have always been so, and it has paid being optimistic. So India is the best place to be. Like I said, you may hate India, but you cannot ignore India.
That's what the market valuations also indicate, Jyoti. Our valuations are the best in the world. That means investors are prepared to pay premium for India.
Thank you so much. With that, we come to the end of this webinar. I'd request Dr. V.K Vijayakumar to say a few words before we wind up.
Well, I don't have much to add other than saying I should both Gaurang and I have great appreciation for the work that Jyoti, Elizabeth, and Arya have done in the back office. Without your very sincere efforts, a webinar of this magnitude is not easy. So thank you all very much. We enjoyed talking to you as much as you enjoyed listening to us. Thank you.
Thank you very much,
Take
sir.
care. Thank you. Thank you. Bye bye.
Bye.
Bye bye. Thank you. Have a wonderful day, all of you.